Now, what everybody does, and Howard, you explained, there is a bell curve. And you want to be on the left of the bell curve, which is actually the same as being the Jedi Master on the right of the bell curve. Everybody in the middle who overthinks it, it's simple. Number go up. That's the whole crypto thematic that you need to know. You can either do all the deep dive, and I must have done 10,000 hours on this, and I might be at the right side of the curve sometimes, but I don't mind being the left either.
Hey guys, welcome back to Everyday Finance. In today's video, Raoul Pal shares his insights on the adoption curve of cryptocurrency and its potential for growth. Understanding the significance of establishing a network of reliable sources and staying up to date on emerging tools and technologies is crucial for billions of users. According to Raoul Pal, our findings indicate that the existing internet infrastructure played a significant role in facilitating the adoption of this new technology. The system that utilizes those rails is significantly faster, boasting a speed that is twice as fast as the previous version. It's truly remarkable how the internet has had such a profound impact on all of us. And now, we're witnessing its influence grow exponentially. Speed is the driving force behind the fastest appreciating asset of all time. The compounded annual returns of Bitcoin, for example, are approximately 150% per year. With 80% drawdowns occurring 4 times in the middle of it, we have never encountered an asset quite like this before. If we simply consider the rate of growth, by projecting the current growth rate, it is estimated that the number of internet users will reach 1 billion by the end of 2025. If we project this trend until 2030, we can expect to reach a staggering 4 billion users. In essence, this is an omnipresent technology that will dominate our lives in ways we cannot fully comprehend. It extends beyond mere existence, centered around investing in cryptocurrencies. It will solely consist of the fundamental framework for conducting transactions, and lots of things Raoul Pal discusses, so please watch the video to end and share this video, and subscribe our channel Everyday Finance. Thanks.
Discovered this chart back in 2020, and what it is the number of active wallets in crypto.com measure this, versus the, active IP addresses of the internet. And I always thought, well, this is a network adoption model, the same kind of thing. It's an adoption of a technology. And I wonder what they look like. And I put them over each other. And what we found was that, obviously, because the internet was the rails that already exists, the adoption of a new technology that uses those rails is faster. And it's actually twice the speed of the internet. So if you can get your heads around how big the internet was for all of us, this is happening at twice the speed. It's driven the fastest appreciation asset of all time. The compounded annual returns of, let's say, Bitcoin is about 150% a year, even with 80% drawdowns 4 times in the middle of it. We've literally never been given an asset like this with an adoption like this. And going forwards, if we just assume that the rate of growth just matches that of the internet from here until the end of 2025, we end up with 1 billion users. And if we extrapolate that out to 2030, we get to 4 billion users. So basically, this is a pervasive technology that's going to take over all of our lives in ways we don't really understand. It's not just going to be about investing in cryptocurrencies. The reason we can't is we can't think in exponentials. We just simply can't as humans, right? I mean, every single person I know, except a few, got wrong Google, got wrong Amazon, got wrong Tesla, got wrong Apple, all of these things. They're all network adoption models. Everyone got them wrong because we can't understand exponentials where growth compounds. And we're seeing it yet again with AI. This is even faster. And humans just can't extrapolate this rate of change. It's that. If the really important thing is, crypto right now is $2.7 trillion industry. It'll probably finish this cycle at $10 to $15 trillion. And by 2030 or so, it'll be $100 trillion, right? This is the largest, fastest accumulation of wealth in all human history. It's as simple as that. That's what that chart tells you. Now, what everybody does, and Howard, you explained, there is a bell curve. And you want to be on the left of the bell curve, which is actually the same as being the Jedi Master on the right of the bell curve. Everybody in the middle who overthinks it, it's simple. Number go up. That's the whole crypto thematic that you need to know. You can either do all the deep dive, and I must have done 10,000 hours on this, and I might be at the right side of the curve sometimes, but I don't mind being the left either. Just don't overthink it. The moment you overthink it, that's when you get yourself into trouble and you start not seeing it for what it is, you see it for what you want it to be.
Many cryptocurrency traders are eagerly awaiting the Bitcoin halving event in 2024, believing it will have a significant impact on the crypto market. However, analysts at Steno Research have a different perspective. They anticipate that it will be a buy the rumor, sell the news event, similar to previous halving events in Bitcoin's history. These events have resulted in a reduction of mining rewards, from 50 BTC to 25 BTC in 2012, then to 12.5 BTC in 2016, and finally to 6.25 BTC in the most recent halving on May 11th, 2020. Steno Research suggests that BTC is likely to follow the pattern of the 2016 halving, where selling pressure increased for up to 4 months after the event. They view the next Bitcoin having as a short-term event driven by anticipation, echoing the pattern observed in 2016. Despite heightened anticipation from Bitcoin ETF holders, the research firm expects a surge in BTC's value leading up to the halving event. However, they also caution that the value could dip below its price at the time of the halving within the first 90 days following the event. Steno Research analysts have observed striking similarities in the price performance of BTC before and after the 2016 halving event. This suggests that we can anticipate similar outcomes from the upcoming event. The report highlights that Bitcoin's price stayed below its pre-halving level for the entire 90-day period following the event. Notably, on the 90th day after the halving, Bitcoin was priced 8.4% lower than before the event. According to data from CryptoQuent's Bitcoin daily mining, the mining rewards are currently at their highest ever as the price of Bitcoin trades close to its all-time high. This means that even though the number of BTC issued will be the smallest yet after the halving, the value of this issuance will be high when measured in dollars. The report explains that with the current price at approximately $71,000, this reduction now translates to $224,500 that the miners received after the last halving. Bitcoin miners have been experiencing record-breaking earnings in recent months. Let's back to the Raoul Pal interview.
Yeah, and listen, if you go to the ludicrous thing that Paul Tudor Jones mentioned a while ago, and Stan Druckenmiller talked about, is 80% of coin holders don't sell, ever.
Yeah, correct. They're in cold storage.
And it's the same with Ethereum, with the staking and everything else. So your actual supply is 20% plus the miners. The miners keep getting halved every 4 years. So you've got no supply. So that's 20% of the let's say of the entire asset class, 2.7 trillion is actually available to buy. You bring something like an ETF and things go bananas. Right, the more people who adopt it, the more the price rises. Also, the really key thing is, I don't know if you guys have ever seen the chart from Fidelity about the risk reward of assets. It's brilliant. So there's this big white page, all Fidelity branded, and here's a cluster of all of here's the NASDAQ, and here's gold, and here's oil, and here's all of that. They're all clustered in the bottom. Then there's a blank page, blank page, blank page, blank page, blank page, dot, Bitcoin. It's a fucking alien asset class. We have never, ever had an asset class with this risk reward over a long-term time horizon and this performance. Yes and no. Because the log chart over time keeps going up, right? The wealth keeps building. It goes from $1 billion to $10 billion to $100 billion to $1 trillion, right? It just keeps building. But your point is really crucial, is very little leaks back into the economy. When I first got into this space, it was because there was no transparency and you don't own the money in your bank account, and you don't own the securities you think you own. And when you saw Lehman, you saw that there's a few collateral assets and there's all this leverage, and it's a big game of musical chairs for who gets a slice of the collateral, right? Nobody owns anything. Blockchain changes that because it's provable who owns it. You can give permission to rehypothecate them, or you cannot, right? So it's a game changer for that. But even in terms of trading, it gives you a whole new set of stuff you didn't have before. Like funding rates are just brilliant because you can see in real time what you'd have to get from a prime broker at Goldman, how funding rates for a particular stock are trading. But here you can see it in real time. You can see when it's liquidated. If you add that with a bit of technical analysis, you've now got a really nice system to figure out, okay, have we got another leg lower or is this over? Stuff like that.
In a blog post on April 8th, Arthur Hayes, co-founder of BitMEX, expressed his belief that the recent integration of Bitcoin with strategies from the United States Federal Reserve and the Department of the Treasury will further fuel the ongoing sell-off of crypto assets, leading to a prolonged period of market depression. Rie predicted that the Bitcoin market would drive up housing prices in the near future. However, Rie also cautioned that the prices of cryptocurrencies could experience a decline both before and after this period. The narrative of positive crypto prices is widely accepted, but it often turns out to be the opposite when most market participants agree on a certain outcome. In light of current circumstances, AES has expressed concerns about the timing of the upcoming event. With the current tightness in dollar liquidity, AES has put forth a theory on how the policies of the US Federal Reserve and Treasury can influence the markets. As a result, AES predicts a potential slump in Bitcoin and crypto prices during the event, which could further fuel a selling frenzy of crypto assets. AES has specifically highlighted the second half of April as a precarious period for risky assets, as tax payments in the US will reduce liquidity. As the Fed initiates quantitative tightening, there is a decrease in the money supply and the Treasury's general account. TGA is essentially the government's designated checking account ready for use. Hayes Road will see changes after May 1st, coinciding with the Fed's meeting. Giggs predicts a slowdown in the tightening of money supply and anticipates the Treasury to inject around $1 trillion of liquidity into the system, which will have a positive impact on the markets. AES mentioned that due to the range of tools available to the Federal Reserve and the Treasury, they have made the decision to refrain from trading until May. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.